I want to start by saying this as clearly as I can because this is where most people get it wrong. Silver is not slow. It never was. What it is quiet. And quiet things make people uncomfortable because there's nothing to react to. No fireworks, no screaming headlines, no dopamine hit. Just tension building in the background while everyone else is staring at the wrong screen. Right now, gold just jumped the fence again. You saw it. Charts lit up. Commentators got excited, and the crowd did what the crowd always does. They stared at gold like it was the whole story. But silver didn't chase it. Silver flinched. And if you've watched markets long enough, you know that flinch matters more than applause. That's the sound of something waking up. Silver isn't a sleepy asset. It's a fast horse tied to a much bigger animal, and when that bigger animal decides to run, the fast horse doesn't warm up. It doesn't stretch. It snaps the rope and bolts. The mistake people make is assuming that because silver hasn't moved yet, it won't. That's not patience. That's denial dressed up as caution. Markets don't wait for headlines. They move before the story gets written. By the time everyone agrees on the narrative, the price is already voted. If you're the kind of person who needs confirmation from a thumbnail, a tweet, or a breaking news banner before you act, I have bad news for you. You're not early. You're not even on time. You're liquidity. There's this comforting lie people like to tell themselves that silver is boring, stuck dead money. I love that lie. Markets love that lie because it keeps people passive, and passive money is easy money to move against. Pressure doesn't announce itself. It accumulates, quietly, methodically, until suddenly it doesn't feel quiet anymore. This isn't about panic. This isn't about the dollar collapsing tomorrow or the world ending on a Tuesday afternoon. This is colder than that, more realistic. Gold is being accumulated for reasons that don't care about your feelings or your timeline. And when that kind of demand shows up, it doesn't travel alone. Silver doesn't shout when it's about to move. It tightens, it twitches, it waits. And by the time most people realize what they're looking at, the fast horse is already gone, and everyone left behind is arguing about why it happened, instead of noticing that it was always going to. Let me reset the frame, because this is where the conversation usually goes off the rails. People love to talk about gold like it's just another trade, an inflation hedge, a chart pattern, a shiny commodity you flip when CPI comes in hot. That's convenient. It's also wrong. Gold isn't behaving like a trade right now. It's behaving like a weapon. And weapons aren't bought for profit. They're bought for protection. When trust starts thinning out, gold doesn't ask questions. It doesn't need earnings growth. It doesn't need guidance. It doesn't care who's in office or what the next data print says. Gold is what you buy when you're not completely sure the promises you've been given will still matter tomorrow. Call it insurance, call it paranoia, call it common sense. Countries don't stack gold because it's exciting. They stack it because it's there when everything else starts negotiating. This is the part retail investors usually miss. Governments don't buy gold because they think it's going to pop next quarter. They buy it because when relationships strain, when supply chains wobble, when phones stop ringing as politely as they used to, gold doesn't ghost you. It sits there, quiet, heavy, honest. And when that kind of demand enters the system, it doesn't come with stop losses or weak hands. That's why gold leads this story. Always has. Always will. Gold is the engine. Silver is the leverage bolted onto it. And leverage doesn't need a long explanation. It just needs motion. Silver doesn't require 10 bullish narratives, a viral thread, and a celebrity endorsement. It needs one thing done right and done consistently. Gold moving with purpose. Here's where people get uncomfortable because this isn't about chasing returns. It's about understanding intent. Strategic buyers don't flinch at pullbacks. They don't argue with charts. They accumulate through boredom and through doubt, and when that bid is real, it drags the entire metals complex with it, whether anyone likes it or not. Silver in that setup becomes exaggerated truth. It's smaller. It's thinner. It reacts faster and harder. That's why it rewards patience and punishes impatience. Gold moves with elegance. Silver moves like it just spilled coffee on a white shirt and panicked. Same direction. Very different behavior. Now let me be clear before someone clips this out of context. This is not me cheerleading silver. Silver can be brutal. It giveth and it takes away with interest. But structurally, when gold is being treated as a strategic asset instead of a speculative toy, silver doesn't get a vote. It gets pulled. And that's the part most people don't want to hear. This isn't about guessing tops or calling numbers. This is about recognizing that when gold stops acting like a trade and starts acting like a reserve, silver doesn't stay quiet for long. It amplifies. It accelerates. And if you're still waiting for permission to believe that history has a habit of teaching that lesson the expensive way, now let's talk about the part of this story almost nobody wants to slow down enough to understand, because it's not flashy, it doesn't trend, and it doesn't fit neatly into a tweet. Free float. This is where smart money separates itself from noise, and where most people realize a little too late that they misunderstood supply and demand their entire investing lives. People love big numbers. They hear how much gold or silver exists in the world and they relax. They say, "There's plenty of it. It can't really move that much. That's like saying there are plenty of cars in the world, so traffic can't happen." It sounds logical until you try driving at rush hour and realize logic just got rear-ended. Total supply is trivia. Free float is reality. Price is not set by what exists. Price is set by what can actually trade without friction, delay, or resistance. And here's the uncomfortable truth. Most gold doesn't move. It sits in vaults. It sits in central banks. It sits as national pride strategic reserve political symbol. You can double the price tomorrow, and most of that gold still won't come out to play. Strategic assets don't flip like day trades. Silver isn't much different, and that's where people really trip. Yes, silver exists in coins, jewelry, cutlery, drawers, pawn shops, and that one weird uncle's basement. But none of that magically turns into immediate market supply. It has to be found sold, shipped, refined, and transformed into something buyers actually want. That process is slow, messy, and very allergic to sudden demand. This is why price always moves first and explanations come later. When demand spikes faster than the physical pipeline can respond, price doesn't wait politely. It jumps. Then supply eventually follows, but by the time it shows up, the move has already happened. Volatility is born in that delay, and volatility is where opportunity and pain share the same address. Here's the image I want burned into your brain. Gold is a stadium. It's massive. You can pour a lot of money into it and the air barely changes. Silver is the small room next door. When money floods the stadium, you hardly feel it. When even a fraction of that money squeezes into the small room, the walls start shaking. Not because silver is special, because it's small. There are companies, single companies, whose market capitalization rivals the entire investable silver market. Let that sink in. Silver doesn't need the world to believe. It needs a handful of large players to move slightly faster than usual. That's it. That's the monster people don't see, because they're too busy counting ounces instead of watching doors. And this is where I get a little sarcastic because it deserves it. Every time I hear someone say, "There's plenty of silver, it's everywhere," I smile. That statement has cost more people money than bad charts ever did. Availability on paper is not availability in practice. Markets don't trade theory, they trade friction. Gold's free float is tight, silver's free float is tighter. And when gold is being accumulated strategically, not speculatively, it doesn't ask silver for permission. It drags it. Silver becomes the exaggerated reaction to the same force. Same engine, smaller chassis, no seatbelt. Once you understand free float, the entire silver conversation changes. You stop asking how much exists and start asking how much can move. You stop waiting for headlines and start watching pressure. And when you see pressure building in a market this small, this thin, and this misunderstood, you realize the real risk isn't that silver doesn't move. The real risk is that it moves faster than people think is possible, and by the time they understand why the door they thought was wide open turns out to be very, very narrow. Now we reach the part of the story where people stop thinking clearly and numbers start doing psychological damage. $100. I want you to forget charts for a moment and just listen to that number. 100. It's round. It's clean. It sounds inevitable. And that's exactly why it's dangerous. $100 is not a destiny. It's not a promise. It's not some magical finish line where everyone high-fives and goes home rich. It's a psychological cliff. Markets don't trade numbers, they trade stories. And $100 is a story you can shout across a room and watch heads turn. That's when rational investors quietly leave and gamblers loudly arrive. Here's how this always plays out. Silver starts moving, slowly at first, then faster. The people who were patient feel smart. The people who ignored it feel annoyed. Then one day you wake up and silver is everywhere. Every thumbnail is screaming upside. Every group chat suddenly has an expert. Your barber has an opinion. That's not confirmation. That's contamination. Late money doesn't arrive early. It arrives emotionally. It buys strength because it's afraid of missing out, not because it understands what it owns. And late money has one primary function in markets. It provides exit liquidity for people who planned their exits before the crowd showed up. This is the part nobody likes to hear, but I'll say it anyway. Liquidity disappears faster than confidence. When prices are rising, everyone thinks the door is wide open. When prices stall, that same door becomes a narrow hallway with elbows flying. Bids vanish. Spreads widen. Market orders turn into donations. And suddenly the asset everyone loved feels personal, like it betrayed them. Silver is especially brutal here because it doesn't correct politely. It doesn't tap you on the shoulder and say, "Hey, maybe take some profit." It snaps. It spikes. It reverses hard enough to make people question their intelligence. That's not manipulation. That's structure meeting psychology at high speed. I've watched this movie too many times to count. People don't lose money because silver goes up. They lose money because they fall in love with a number. They start believing that selling before the headline is somehow a failure, that real winners hold for the screenshot. That discipline is weakness. That's how portfolios get shredded near peaks while everyone is busy congratulating themselves. Let me be very clear. When silver approaches a number like 100, the question is no longer how high it can go. The real question becomes how easy it will be to get out if you're wrong. And that's the question almost nobody asks when adrenaline takes over. Markets don't ring bells at the top. They whisper warnings. Silver failing to rally on strong gold days. Sharp spikes that instantly reverse. Volume screaming while price goes nowhere. Those are not signs of strength. That's distribution. That's smart money handing risk to excited hands with less experience and more confidence than they can afford. And here's the irony that makes me laugh every time. Selling most of a move often makes you nearly as much money as selling the exact top without the ulcer. But ego wants perfection. Ego wants the story. Ego wants to say, "I called it." Markets punish ego without mercy. So no $100 is not a goal. It's a stress test. It's where discipline either shows up or gets exposed. And if you haven't decided what you'll do before that number starts dominating conversations, you won't decide it calmly when the screen is flashing and everyone is shouting. That moment right there is the cliff. And the difference between professionals and participants is simple. Professionals already know where they're stepping. Everyone else figures it out on the way down. Let me slow this down right here, because this is where the fantasy usually dies, and reality steps in without asking permission. I am not here to sell you a dream. Dreams are cheap, discipline is expensive, and that's why so few people buy it before they need it. Silver doesn't reward optimism. It rewards preparation. And if you don't accept that volatility is not a bug, but the core feature silver will teach you that lesson personally, and it won't be gentle. Silver breathes in 20% moves. That's normal. That's not a crash. That's Tuesday. If a 20% drawdown makes you stare at the ceiling at 3 in the morning questioning your life choices, your position is too big. Period. The market doesn't care how convinced you are. It only cares how exposed you are. Conviction without position sizing is just bravado with a countdown timer. This is where I give people a rule that sounds stupid until it saves them money. Imagine you wake up tomorrow and your broker accidentally sold your entire silver position at the exact same price and chart you see today. No profit, no loss, just flat. Ask yourself one honest question. Would you immediately buy it back? If the answer is no, holding it right now is irrational, because holding is choosing to buy again every single day. Most people hate that question because it removes emotion and forces logic back into the room. Another uncomfortable truth is this. You do not need to sell the top to win. Selling 70, 80, even 90% of a move often gets you almost the same result as selling the perfect high without the stress, without the paralysis, and without turning a winning trade into a morality test. The market does not give out medals for bravery. It gives invoices for mistakes. People love to say they're long-term until volatility shows up and exposes that they were actually short patience. Silver will test your temperament faster than your thesis. It will run ahead of you, stall reverse shake you, and then take off again just to see who actually knows what they're holding. If you don't decide your rules before that happens, you will invent rules in real time. And rules invented under adrenaline are always bad rules. Here's where I get a little sarcastic because it's earned. Every cycle someone says, "This time is different. I'm holding through everything." Great. That's not courage. That's negligence without a plan. Holding blindly is not discipline. Discipline is knowing when to reduce risk, while everyone else is increasing theirs, because it feels exciting. Preparation is boring. It doesn't screenshot well. It doesn't get applause in comment sections. But preparation is the only reason professionals survive markets that chew through enthusiasm like it's disposable. You don't prepare exits because you're bearish. You prepare exits because you respect how fast liquidity can vanish when everyone wants out at the same time. Silver does not forgive hesitation. When it turns violently. Bids pull back. Spreads widen. Suddenly, the price you thought was there only exists in memory. That's when people realize too late that confidence is not liquidity. Liquidity is agreement, and agreement evaporates under stress. So let me say this clearly. If you haven't already decided how much you're willing to lose, how much you're willing to keep, and how much you'll trim into strength, you are not managing risk. You are hoping, and hope is not a strategy, it's a mood. I'm not telling you to fear silver, I'm telling you to respect it. This market can make people very wealthy, but only if they survive the part where ego tries to take control. The goal is not to be right at dinner parties. The goal is to still be standing when the noise fades and the next opportunity shows up. Greed tells you to press harder because the crowd agrees with you. Discipline tells you to scale out while the crowd is still cheering. One of those voices will feel uncomfortable. The other will feel exciting. Only one of them keeps you solvent. If you walk away from this with nothing else, remember this. Silver doesn't destroy portfolios. People destroy portfolios by ignoring their own rules. And the market never punishes you for what you know. It punishes you for what you thought you could handle. Let me zoom the camera out because if you're still thinking about this as a trade, you're missing the real story. This is not just another cycle where prices go up, people celebrate, and then everything resets neatly back to normal. Normal is changing, quietly, structurally, and markets always adjust to structure before they adjust to headlines. What we're watching right now is tension stacking across systems that used to feel stable. Supply chains that were optimized for efficiency are being rebuilt for resilience. Countries that once trusted distance and diplomacy are now paying for redundancy. Factories are coming home. Energy grids are being hardened. Logistics are being redesigned. None of that happens on spreadsheets alone. It happens with physical inputs, real materials, real metals. This is where silver stops being just an asset and starts becoming a component. AI doesn't run on optimism. It runs on data centers, power infrastructure, and hardware that needs conductive materials. Energy transitions don't run on slogans. They run on wiring, storage, and industrial-scale deployment. Logistics doesn't move on press releases. It moves on physical systems that require resources to exist before they can operate. Governments understand this instinctively, even if they never say it out loud. They don't wait for charts to look pretty. They don't need momentum indicators to feel comfortable. When they decide something matters, they accumulate it steadily, quietly, and without regard for whether it looks smart on social media. Strategic stockpiling is not a trade, it's posture. This is why gold has been treated differently and why silver sits in its wake, whether anyone wants to acknowledge it or not. When nations prepare, they don't prepare for certainty. They prepare for probability. Markets don't move when something becomes inevitable. They move when the odds shift enough that ignoring them becomes irresponsible. People love certainty because it feels safe. Markets love probability because it creates motion. You don't need a war to break out for metals to reprice. You don't need a crisis to explode on television. You need enough overlapping risks to make preparation rational. And that line has already been crossed more than once in the last few years. Here's the part that usually makes people uncomfortable. This isn't about collapse. It's about friction. It's about a world that's less smooth, less predictable, and more expensive to operate. Reindustrialization costs money. Redundancy costs money. Energy security costs money. And whether governments spend wisely or foolishly, scale spending tends to pressure currencies and elevate the appeal of hard assets over time. Silver fits into that picture not because it's glamorous, but because it's necessary. It doesn't need to be loved, it needs to be used. And when something is both financially small and industrially relevant, it behaves very differently than people expect when demand shifts even slightly. This is why I keep saying markets respond to probability, not certainty. You don't wait for the fire to start before buying insurance. You buy it when the smoke starts appearing in places that used to feel fireproof. The repricing happens before consensus, not after. So no, this isn't a neat cycle where you mark your calendar and expect symmetry. This is a reconfiguration of priorities. Power production and protection are being recalculated at the same time. And when that happens, assets that sit at the intersection of finance and function stop behaving politely. You can ignore that and keep trading headlines. Or you can recognize that when the big picture shifts, the smaller markets tied to it don't get a choice. They get pulled into alignment. Slowly at first, then all at once.